Ladies and gentlemen,
Good evening.
Are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
Hi, it's Joanna Oakey here and welcome back to the Deal Room Podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. Now, in this episode, we pick up right where we left off in part one and head to the show notes if you missed part one to link back to that episode. In this part two, we are joined once again by two highly experienced business brokers, Hugo Martin and Travis Latter. And in this episode, part two of our due diligence insights from AIBB Best Practice Forums, we dig into how business brokers and sellers should approach working together from the outset. Now, these insights aren't just great for business brokers. They're good for buyers and sellers to hear and to understand the broker's perspective, what to expect when working with a broker, why they ask or do things a certain way, which is great preparation for anyone considering selling and looking into working with a business broker. In this episode, we talk about when business brokers and advisors should walk away from a listing and how to do it professionally, the due diligence red flags that signal serious deal risk, and why rigorous pre-due diligence preparation is critical to keeping transactions on track. So let's dive in.
How do you politely decline a listing whilst maintaining that professional goodwill, especially if you're working in a specialist area where there's not many people operating, or you're in a regional area, or you're even in Vegas? That you word gets around pretty quick. How do you decline a listing?
How? Well, I will analyze it, bring data to support my arguments in terms of when I appraise the business to look at it, and through a process of negotiation, I will say I may not be the right person for you. Or there might be a personality issue. I said, maybe I'm just not the right person for you. Or they'll come up and say, listen, I have an expectation of price, and I will put forward a position that says that doesn't meet what I believe the business will achieve in the market. And I will say, if you truly believe that that's what you want and somebody else can get it, I'm more than happy for you to go and find another broker to do that job for you, but I may not be the person in that situation. But there are times, when you have that referral, when it'll come through, and the better side of you knows you shouldn't be doing this, but sometimes there's a social service that has to be provided, and that's part of our job. I think sometimes you just have to help people.
Joe and Hugo, I'm going to ask a question and you're going to probably have multiple answers, but I just want you to fire them straight at me. What are some red flags that justify walking away? Joe?
Sorry, do you mean for a broker?
For a broker to walk away, what are some red flags?
Yeah, like if you find the vendor's not being truthful, like I'd walk if I was you.
Yep. What else?
I don't know about, I don't know, I can't think of anything else that's like a hard walk away, because I think most other things can be dealt with. Of course, there's lots of things, if you're identifying, looking through the business, you find, owners, founders are not on the same page about a sale, like huge red flag there. We've seen lots of issues where you get to the sale doorstep and then you can't do it. And that's just obviously a massive waste for everyone. But is that absolutely turn away? Maybe not, but you've got to resolve it from the beginning before you continue. So I think that's something that I see on a recurring basis, that issue with sellers or, part owners not being on the same page. But other than that, other things that you identify in the business as problems, most of them will have some sort of resolution, but there might be a delay you might there might be a delay before in order for that issue to be resolved, but doesn't necessarily mean walking away in other areas, I guess.
For me, again, truthfulness is the key one. If I find out that someone's not telling me the truth, then that's a definite no for me. And also, if people are not prepared to give the information that I request, which would be a reasonable expectation from a buyer's perspective, and from me as a business broker to be able to assess the business. If I can't get the information I need to assess the business properly, then there's no point in proceeding. They're the key ones for me.
Yeah. So, so I'm going to list a few that came up. So I've got vendor unwilling to disclose financials, unexplained inconsistencies between verbal claims and documents, unrealistic price expectations despite the evidence, aggressive or manipulative communication style, signs of pending legal or tax issues, my accountant will fix it later attitude, conflicts of interest, obviously, between business partners, a refusal to pay marketing or valuation fees up front, and poorly organised documentation or fabricated looking financials. They're just some that sort of have come up that, and again, it's about making sure we maximise our time. Our trading commodity is our experience, our expertise and time. Joe, this question's for you. When does helping cross the line into enabling? Or what about when you are spending too much time consulting and you're not getting you're not getting any further than that?
For a broker, you mean?
Yeah.
I mean, look, you guys are in a hard position. I guess that's interesting, Travis, when you talked before about what are the hard, no's and turn away. I didn't think of any of those things because I don't have to deal with the filters that you guys have to, because people pay us in a different way. The new guys are paid. So, and when I say guys, I mean, like, obviously, guys and girls, broadly here. So I guess it's not something that I had to ponder so much, but it's something certainly that I guess, when I see transactions and I see different transactions at different levels of the market and in different industries have different levels of falling over. So for us, deal falls over, we still get paid. For you, deal falls over, you don't get paid. We only really see the transactions, unless it's a client that we've been with for a long time. And those clients, to be honest, once they get into a sale process, they're ready for it, right? But most clients that haven't been with us for a long time, we only see when you've already agreed commercial terms and you're somewhat through DD and, you're at a serious stage. For you guys, I guess, like, there's a lot that fall over before there. But the things that I see as consistent for deals that fall over once they come into our arena, number one, something's not being truthful, something's pulled out of due diligence, maybe that the seller didn't even realise. And I think that's really a key thing and I think we're probably talking about that later on, but from a due diligence perspective, for you preparing your clients for due diligence, like, the absolute imperative is that they see the problems, you see the problems, the lawyer sees the problems before the buyer sees them, because often it's not the seller's actually meaning to withhold information. It's just a risk that they haven't realised is sitting there. But whatever the reason, it still kills trust. It kills trust for the buyer's perspective. A, they don't know if it's been withheld on purpose. B, it raises concerns for them about what else there might be sitting in the business that they haven't picked up. So I really think it's about that like preparation for your sellers right from the beginning. I can't even remember what you asked, Travis.
No, it wasn't that, but that's okay. I'm used to that, Joe. Hey,
also, Travis, we do have an advisory role. I mean, a lot of our time really is spent providing sound information. We're a springboard. I mean, we live and breathe the market, and people are constantly contacting us to say, what's our opinion? What are we going to do? Is this the right time? Or just seeking general business information. And I think we do spend an awful lot of time in an advisory capacity, which probably doesn't result in payment immediately, but it's a solid investment into future earning capability.
Hugo, how many years have you been broking, Hugo?
20.
How many deals in those 20 years do you reckon you've done?
Oh, goodness me, hundreds.
How many have fallen over in due diligence?
In the last 10 years, last 15 years, 0.
Sorry?
0. In the last 15 years, I haven't done one. I really rigorously do a pre-due diligence myself on the business. There are other reasons why it may have fallen over. Finance might be one, unexpectedly, or a really recalcitrant landlord where we may require multiple contracts to get a deal accepted by them. But just general due diligence, in the last 15 years, I haven't had one fall over on actual DD.
And what would you put that down to?
Well,
what's your secret?
Well, we do your prep work. Make sure I do a pre-contractual due diligence on all my businesses. I'll try and know as much as I'll anticipate the questions. I'll try and know what the stakeholders from all the sides will be looking for and checking. And I'll do that myself. I'll look at the financials, and touch wood, maybe I've just been fortunate, but like I said, none have fallen over actually on the actual due diligence itself.
Joe, if every party has a different version of reasonable due diligence, whose standard prevails?
Well, the buyer's got the power, right? But it depends. It depends who's got the power on the basis of how much competitive tension there is. But here's the reality that we need to take our sellers through, I think. If sellers want a higher multiple, they get a higher multiple from a more sophisticated buyer. A more sophisticated buyer is going to have a more sophisticated and thorough approach to due diligence. Like I've been on deals where, maybe it's 5, 10, 15 million, and we have a corporate buyer, a highly sophisticated buyer, and we have top tier legals acting for the buyer. And the seller's just like, I can't deal with all of these requests that are coming through to me. But if they're getting a multiple that's really good in the market, you're making a choice here. It's sort of a return on your investment of time. There's a portion of the market that we can go after where this due diligence requirements will be lower. There's a portion of the market that we can go for that are going to pay a higher multiple, but you're going to have to jump through hoops for that, and you're going to have to be well prepared in advance. So, so that's that sort of end of the market. If there's the end of the market where they don't have the opportunity of a corporate buyer, they don't have a sophisticated buyer that's there, it's just buyers being painful, which first-time buyers, in smaller transactions, sometimes first-time buyers are the ones who don't understand the process, are the ones who have to have their expectations readjusted. But there's nothing better than having an alternate buyer on the hook that you can go to in that situation, so that, because, a buyer needs to take needs to go down the path they feel they need to in order to feel secure about the investment that they're about to make.
But sometimes the horse has already bolted, and you've started to share information, and you suddenly realize you're sharing too much information, and it's not due diligence, it's operational stuff now. So Hugo, how do you A, pull it back, or B, not ever allowed to get to there?
Well, we're stakeholder managers, so we're intermediating a deal. So it's about clearly talking to the buyer and seller about what the requirement is from both sides and what is reasonable in order to proceed to the next stage. So I'll have buyers who want names of customers, supply lists, and all this sort of stuff. And I will explain before we start the due diligence that will not be available. That's intellectual property, and that's information that will be available once the deal goes unconditional. I think you have to set the parameters. Obviously, there's a little bit of scope creep in some of these deals, but generally speaking, it's about really having a really good conversation with both parties and their legal and financial representatives, so everyone's on the same page before we start the process.
And
So-
I was just going to say, I say to my sellers, before a contract is unconditional, essentially, you can't be handing across information. There's this balancing act.
Yeah.
Sellers have to really be very conscious of this balancing act between providing enough information for the buyer to assess the business at the stage of the transaction they're at. So there's different levels of information that are needed at different stages, right? But then a second element, you should never be handing across information that could be detrimental to your business if that information is out in the public, if this transaction doesn't continue. So and so you can get there by it's understanding what is the buyer actually asking for. And I've had to sit down and have sort of super robust conversations, but with buyers who've been asking for everything, including the kitchen sink, in relation to a business sale, and sort of getting out of that. Well, what do you want? What is it you're trying to get out of that information that you need to analyse whether or not this is the right business for you? And on the flip side, how can we deliver that? By redacting information, by grouping information, by doing whatever we need to do to preserve our commercial sensitivities. But the one other side I always say to our sellers is, I have to be honest, the things that you think are super important and confidential in the market, like may or may not actually be an issue if they ever got out. Do you know what I mean? Because like so many times our sellers are like, oh, our margins are so important for no one else to know or whatever. And but buyers who are assessing these things, like they see all of this stuff all the time. They don't care they're just using it for their assessment. So I think it's sort of like walking back sellers from being overly cautious, but also making sure they keep a lens on to make sure they're not over disclosing.
That's part of the process, isn't it, of preparing your clients and for them to have a clear understanding of what's required from a buyer's perspective. I always say, if you're the buyer, what would you reasonably expect to be provided for you to buy this business? You know it intimately better than the person who's going to buy it. So is this really unreasonable?
Joe, to you, how do you handle conflicting professional advice from each side's accountants or solicitors?
Sorry,
they're looking at the same data. Both accountants, both solicitors, but the broker, the buyer, the vendor, looking at the same data, but they're pulling different things out of it. How do you handle the conflicting professional advice that a buyer might get to the professional advice if you're acting sell side?
Well, I always opt for, for me, it's conversations, it's communication. So if there's
that's the what, but the how.
Yeah. So if there's if I feel like barriers have come up because there's different opinions, and usually then I'm speaking to the lawyer on the other side. If I can't get them, I'm in an all parties meeting and we're doing it all together publicly together. I'm all for move quickly into all parties meetings, but all parties meetings usually is enough to scare the other side to at least get on the phone and have the conversation or move their position, because lawyers hate being in a room having to justify some of the crap they put in these contracts, right? So it's communication, and you do it via the threat of an all parties meeting, I think.
Yeah. I use that too.
Joe, term sheet, big or small? Should you have a all-encompassing term sheet that covers off on most things you're going to find, and then basically drop it straight into the sale contract, or should you have something minimal work through? What's your thoughts there?
I have very strong views on this and possibly very different to everyone else, but that's okay. I'm okay with it. I'm all for short-term sheet. I hate long-term sheets. I hate highly detailed. I hate doing too much negotiation at that stage. I like to put all the negotiation together because I feel we make our negotiation bitsy. So that's my approach. I get it. Lots of people disagree with me. So fine with that, but that's my preference.
And how do you manage the renegotiation, especially if you have been blindsided?
It hasn't happened to me, but I could, to be honest, not materially, no. I mean, you'd have to get your client in a room and say, look, there's some adverse material that's come to light that materially impacts on the value proposition. What are your instructions? And then talk to their lawyer as well and their accountant to see, is there a possibility that there's a mistake? Can this be resolved? But I have had a situation where something where a client, through the DD process, a key client was lost to a company, which had a material impact on the projected cash flow for the following year. But the buyer wanted that business and was prepared to continue at that price because he felt that he had mitigators in place and other clients who would take up that slack. So that's the only situation I've come across in that situation.
Can I just throw something in that I just wanted to mention, but I haven't yet, but I just wanted to sort of warn about this difference between share sale and business sale. Everyone should be ensuring their sellers get proper tax advice before they head into a sale, that they understand the tax that they're going to pay, how that works. But you quite often, you might have this instance where in a business that shouldn't be a share sale, the accountants come back and said, it needs to be a share sale to save tax. And I think the most important thing is if there's not a lot that is at play there in terms of the tax saving, and it's a business that's sort of like sub 2 million and there isn't an otherwise driving reason for a share sale, like for example, the industry that they're in or whatever, I think you have to make sure you tell your sellers the different level of DD that will happen and the different level of warranties that will apply to them in a share sale versus a business sale. Because it's just important that they understand that right at the beginning rather than start whinging when the buyer does a lot of DD. So, because them, it's a trade-off. They're getting a tax advantage, but they're going to have to put more time into DD responses. Well, that's it for this episode of the Deal Room podcast. We hope you're now primed for your next deal with these pointers and have enjoyed these fascinating insights. Now, if you'd like more information about this topic, then head over to our website at thedealroompodcast.com, where you'll be able to download a transcript of this episode, as well as access any contact details and any other additional information we referred to in today's podcast. Now, if you'd like to get in contact with our guests today and the services they offer, you can go ahead and check out our show notes for a link right through to them and their details. You can also book in directly with our legal eagles at Aspect Legal if you'd like to soundboard your next steps, discuss a legal question, or find out more how we can assist, whether that's with buying or selling a business, or perhaps somewhere in between. Now, don't forget to subscribe to the Deal Room podcast on your favourite podcast player to get notifications whenever a new episode is out. We'd also love to hear your feedback, so please leave us a review and rating if you're already one of our subscribers, or even if you're listening to this podcast for the very first time. Every review helps our team produce valuable content for you. Well, thanks again for listening in. You've been listening to Joanna Oakey and the Deal Room podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. See you next time.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room Podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.